The MD Investor channel where we're talking about personal finance, setting goals, achieving goals, educating ourselves and our children so we can break the cycle of generational poverty. We've been going through back to school, different lessons in personal finance, but today we'll take a break and we'll talk about Donald Trump's taxes. Just my thoughts and a few pointers, and that will be done. Before we get into it, if there's people out there you think could benefit from this personal finance information, let them know about the MD Investor on YouTube with MD Investor and on Instagram MD Investor One. Without further ado, let's get into it. So it said the Times obtained Trump's tax information extending over 2 decades, over 20 years, revealing struggling properties, vast write-offs, an audit battle, and hundreds of millions in debt coming due. First of all, let me say I'm not a tax attorney, I'm not a CPA, none of that. But the first sentence here gets me. We'll read the first two. Donald Trump paid $750 in federal income taxes the year he won the presidency, 2016. In his first year in the White House, he paid another $750, 2017. He had paid no income taxes, zero. He had paid no income taxes at all in 10 of the previous 15 years. So $750 in 2016 in federal taxes, another $750 in federal taxes in 2017. But for the previous 10 out of the previous 15 years, he paid zero. He paid no income taxes at all in 10 out of the 15 previous years, largely because he reported losing much more money than he made. This goes into detail. I read almost all of it. I'm not gonna, begin to reiterate, but there's a couple of points. One, it's better to be in business, an employer, than to be a W-2 employee. That's a fact. Just as a fact. As a employee, you do have certain deductions and so on. You have the standard deduction now. Single, $12,200. Married, $24,400. Or you can do the itemized deduction. Mortgage, you have the mortgage interest. It's a couple of things that you can deduct, but nothing compared to being an employer. You can deduct the losses, which is what Trump did, and they can be carried forward for many years. We'll probably get into that in a little bit. They can deduct the depreciation of the assets, such as in real estate, right? So, you may say, they may give you 20 years, right? And you may say the asset, the building, whatever, it depreciates X amount of percent, 3% per year, and they can deduct that, even though they're still getting rent and so on. Anything you do with the property to upgrade it, to maintain it. You got a new roof, deductible. A new driveway, deductible. A new sprinkler system, deductible. New kitchen, new appliances, deductible. You had workers come in and they work 1099, you pay them, their income is deductible. So there's a lot of deductions available for real estate developers, employers in general. The amount of money you paid, the salary you paid, the benefits you paid to your employee, deductible. So that's step number one, or that's point number one. It's better to be an employer than a W-2 worker. I did a video on that. Don't raise your kids to be W-2 employees. Also better to be investors. Okay. So essentially what this talked about is that Trump had, even though he said that he's a great businessman and all this, what the Times showed is that he had multi-year losses, large losses. One of them was almost $1 billion, about $915 million in losses. And as I mentioned before, the IRS allows you to because he showed that his losses outweighed his income. Essentially, he was in the red. He wasn't making any money. He wasn't. He didn't have to pay taxes, federal taxes, and not only for 1 year, right? You can carry the losses forward. Say, for example, you have a $915 million loss, so you don't have to pay taxes in that year. But you can also carry it to the next year. I think he was allowed to carry it for like 18 years. You carry it until you begin to make money. They say he didn't make money until I think The Apprentice, the show The Apprentice, he started making money. So he was able to carry this forward for years and years and years and years. Um, and that's how he was allowed not to pay any taxes. Like I said, there's a lot of details in some of this stuff. But the point that I wanna make is that we have to do more than just tell our kids to study hard, be on the dean's list, and go get a W-2 job. We have to show them another way, another avenue where they can still make money and keep more of it. Don't pay such a large amount of a large portion to taxes and legally. So let's look at the first thing I want to talk about. I like this one. It says here, even the lowest paid workers in America have a higher tax bill than Trump. Isn't that, I guess it's sad, it's funny. It's a shame. That's really what it is. A billionaire, right? So it says here, based on the tax brackets, standard deductions, and personal exemptions allowed at the time, 2016, 2017, that's equivalent to the income tax bill for a typical single worker earning just $17,850 in 2016 and $17,900 in 2017. So what they're saying here is that the amount of tax, the amount of federal income tax that Trump paid in 2016 and 2017 was the equivalent of a fast food worker. So here you are, you have a real estate developer, a real estate mogul that fancies himself as a great businessman, paying the equivalent federal income tax of somebody working at McDonald's. I mean, this really is outrageous, but apparently it's legal. We'll see how everything works out. So I thought that was a great point. Let's fast forward a couple of years to we just pay taxes in 2019. And this is kind of what I want to get to. We have to show our children, and I did videos on this already, about the difference between how you're taxed as a W-2 employee and how you're taxed as an investor, such as an investor that has dividends. And we have to teach this to our children, okay? On the 1040, which I did a video in, I think we showed the difference between a W-2 person and a person making their money in dividend. On the 1040, there's a line, I think it's line 3, for dividends. We don't look at that because we never had dividends, but now that we're learning. So here is the 2019 federal income tax bracket, right? So let's take someone, a single person, who makes $50,000, right, at a W-2 regular job, $50,000 in wages. The standard deduction now for 2019 for a single person is $12,200, right? So let's take $50,000 and we take away the standard deduction of $12,200, bring them down to $37,800 in taxable income. $37,800 in taxable income. That puts them here in the 12% tax bracket, right? $37,800, you're here in the 12% tax bracket. You already know that we're in a progressive tax system, so they're not going to pay $12,000. They're not going to pay 12% on the entire $37,800. They're going to pay 10%. They're going to pay 10% on the first $9,700, which is going to be 10%. That's going to be $970, and then on the next portion from $9,701 up to $37,800, they'll pay 12% on that portion. And I already did the math for you, and it's going to be $4,341.88. It's going to be your total federal income tax. So if you're a single person making $50,000, take the standard deduction, and their total federal income tax is $4,341.88. Trump paid $750. So they're paying probably 5 times as much as Trump is paying in federal income tax. Is that not outrageous? Now, let's look at another single person, but they make their money through dividends. Again, they also make $50,000 in dividends. They take the standard deduction of $12,200, bring them down to a taxable income of $37,800. Dividends are considered long-term capital gains if you have held a stock for, I think, for more than, there's a certain characteristic, I think more than 60 days, they're considered qualified dividends. I think 60 days around the time of the ex-dividend date. But most of your companies are going to be qualified dividends. Your typical McDonald's, Home Depot, Caterpillar, so on. Qualified dividends. So $50,000 in dividends, standard deduction of $12,200, taxable income of $37,800, and you're single. $37,800, you fall into this category, and you're going to pay 0% to your federal government. With the first example of the person who was working a W-2 job, same income, same deduction, and they paid about $4,300 in federal taxes. But this person who had the same income, same deduction, but their income is not coming from work or earned income, it is dividend income, and they pay 0% in taxes. That's a difference of $4,300 approximately. Let's look at a married couple, and they have a job, a W-2 job. So we're over here, married couple, W-2 job, and let's say their earned income was $100,000 because they're married. The standard deduction for a married couple is $24,400. That brings down the taxable income to $75,600. So they'll be here. $75,600 falls in this category, or the 12% bracket. The first $19,400, they'll be taxed at 10%, and the next section from $19,401 up to $75,600, they'll be taxed at 12%. Total tax, federal income tax, $8,683.88. So about double what the single person paid in federal income tax. Okay, now let's look at a couple who is also making $100,000. Also take the standard deduction of $24,200. Also have a taxable income of $75,600. And it will put them in this category, $75,600. The difference between this couple and the other couple is that their income is from dividends, not earned income, dividends. And because it's dividend income, it's considered long-term capital gain, and $75,600 falls in this bracket, which is a 0% bracket. No federal income tax for this couple. So the difference between the couple that was earning their money at a W-2 job and this couple who had all their money or all their income from dividends is about $8,600 difference. That's the difference. Okay, one is working hard, and one of them money is working for them, but the government punishes one and rewards the other. Okay, what just want to bring that point out in this whole hoopla about Trump's tax bill. But again, it reveals a lot of things, what we have suspected for a long time, why he didn't want it to be revealed, but obviously it's now been revealed. So this little thing, guys, I want us to keep in the back of our mind. Just remember, there are other ways to skin a cat. We can earn income, and we all start out that way, but eventually we have to begin to divert active income into passive income and to the tax benefit. We should benefit from it, and our children should benefit from it by teaching. If there's people out there, guys, you think could benefit from this information, let them know about the MD Investor. Let them just remember to subscribe. To show that you enjoy the content and it brings value to you, and hit the notification bell. You'll be notified when new content comes out. And remember, the past is gone. We can't do anything about it, but we can learn from it. In the present, we're going to plant seeds so we can enjoy an abundant harvest, okay, which is our reward for all the hard work that God has given us under the sun. I will see you on the next one.